When most people see a market crash, they feel fear. But when the wealthiest people in the world see one, they smell opportunity. Here's something you need to understand. Recessions aren't really where wealth is destroyed. They're where wealth is transferred. Now, this isn't some conspiracy theory, it's just history. From Rockefeller to the titans of the 2008 crash, there's a hidden playbook they used to turn chaos into a cash machine. In this video, we're tearing out the pages and showing you exactly how they do it. When an economic crisis hits, the story for most of us is pretty much the same. Panic is everywhere. You watch your retirement account shrink. You hear friends and family worrying about their jobs. Your natural instinct is to pull back, sell everything, and maybe hide your cash under the mattress, just hoping to survive the storm. This is a strategy built entirely on fear, and it's a guaranteed way to lose. But at the exact same time, a tiny fraction of the population does the complete opposite. While everyone is stampeding out of the burning building, they are calmly walking in. They see all that panic not as a threat, but as a once-in-a-decade sale. It's like a Black Friday for assets, where everything from stocks to real estate gets a massive markdown. They understand a fundamental truth: real fortunes aren't made when markets are soaring and everyone feels like a genius. They are forged in the fires of a crisis. This is the great wealth transfer, and it happens every single time. So, what is this hidden playbook? It's not about some complex algorithm or secret insider information. It's about a set of timeless principles, a specific way of thinking, and the discipline to act when everyone else is paralyzed by fear. And today, we're going to break it all down, starting with the man who practically wrote the first chapter. Section 1. Historical Case Study: The Architect of Crisis Investing. To really get this, we have to go back to the late 19th century. The oil industry was like the Wild West, volatile, unpredictable, and crawling with speculators. Prices would swing like crazy. Every time a new oil well was discovered, prices would crash. Refineries were popping up everywhere, creating 3 times more capacity than there was oil to process, and most of them were losing money. It was an industry stuck in a cycle of boom and bust. In the middle of all this chaos was a young, disciplined bookkeeper from Cleveland named John D. Rockefeller. While everyone else saw unpredictable gambling, Rockefeller saw a chance to bring order to the madness. During one especially brutal crisis, the Panic of 1873, a deep recession took hold. The price of oil plummeted. One historian noted that oil prices fell to just 48 cents a barrel in this era. In some places, water cost more. So what did Rockefeller do? He didn't panic. He didn't sell. He did the opposite. He saw this crisis as the perfect moment to consolidate the scattered, broken industry. With his company, Standard Oil, he began methodically buying up his struggling competitors at rock-bottom prices. His offer was simple: we will take your burden. He used his deep cash reserves and the pure panic of his rivals to his advantage. This wasn't just a hostile takeover, it was a strategic masterpiece. By scooping up dozens of smaller, inefficient refiners, he created economies of scale the world had never seen. He drove down his own costs, invested in technology, and because he controlled so much of the refining and transport, he could handle price swings that would have crushed anyone else. By the time the crisis was over, Rockefeller's Standard Oil controlled around 90% of the US oil industry. He didn't just survive the crisis, he used it to build an empire. Section 2. The Secret Principle Revealed. What Rockefeller did wasn't some secret trick. It was the application of a powerful, counterintuitive principle. In moments of maximum pessimism, the greatest opportunities are born. Think about it. The average person equates falling prices with loss. They see red in their portfolio and they sell, locking in those losses for good. The wealthy investor, on the other hand, equates falling prices with discounts. They see that same red and think, the world is on sale. Now, this isn't about blindly buying junk just because it's cheap. It's about having a shopping list prepared before the sale ever starts. Rockefeller wasn't buying worthless refineries. He was buying valuable infrastructure and talent for a fraction of what they were actually worth. He had a long-term vision that oil was going to power the future. The short-term panic of everyone else was just the entry point he needed to execute his long-term plan. This mindset is the absolute core of the playbook. It requires you to separate your emotions from your investment decisions. It demands that you have the courage to buy when your stomach is in knots and every headline is screaming that the world is ending. It's a principle that has been proven time and time again, most recently in a crisis that many of us lived through. Section 3. The Modern Playbook, the 2008 Financial Crisis. Fast forward to the fall of 2008. The global financial system was teetering on the brink of collapse. Lehman Brothers had just gone bankrupt, and sheer panic had gripped the markets. It honestly felt like the end of capitalism as we knew it. For most people, it was a time of intense fear and financial pain. But for Warren Buffett, it was time to go shopping. In the darkest hours of that crisis, Buffett made a legendary move. He invested $5 billion into Goldman Sachs, one of the very investment banks at the heart of the storm. It wasn't just a financial investment, it was a massive vote of confidence that sent a shockwave through the market. But it was also an incredible deal. In exchange for his cash, Buffett got preferred stock that paid him a 10% annual dividend. That's $500 million a year. At one point, he famously remarked that the deal was paying him $15 a second. When Goldman Sachs eventually bought back the shares, Berkshire Hathaway walked away with a profit of over $3 billion. And he didn't stop there. He publicly declared in a New York Times op-ed, "Buy American. I am." He was living out his most famous advice: be fearful when others are greedy, and greedy only when others are fearful. It wasn't just Buffett either. Private equity giant Blackstone saw the absolute carnage in the US housing market. Instead of running from the fire, they ran toward it. Starting in 2012, they founded a company called Invitation Homes and went on a massive buying spree, spending over $10 billion to acquire nearly 50,000 foreclosed single-family homes at rock-bottom prices. They then turned these houses into rental properties, building the largest private portfolio of its kind. This massive bet on the US housing recovery paid off enormously. The principle is the same as Rockefeller's, just in a different century. When fear is at its peak and quality assets are cheap, the prepared investor takes decisive action. If you're finding this valuable, and if you're ready to start rewriting your own financial story, do me a favor and hit the like button and subscribe to Wealth Saga. We're all about giving you the strategies you need to build real wealth. Section 4. The Mindset Shift from Consumer to Investor. So, how do you actually bridge the gap between titans like Rockefeller and Buffett and yourself? It all starts with a major shift in how you think. You have to stop thinking like a consumer and start thinking like an owner and an investor. Here's an analogy. When your favorite store has a 40% off sale, do you panic? Of course not. You get excited. You see it as a chance to buy things you already wanted at a fantastic price. You need to apply that exact same logic to the stock market. When the S&P 500 is down 30%, it's not the apocalypse. It's a 30% off sale on some of the greatest companies in the world. The system is practically designed to trigger your emotional, primal fear. Watching your life savings go down is terrifying. Your brain screams, "Make it stop," by telling you to sell. This is the exact panic response that the playbook is designed to take advantage of. To flip the script, you have to retrain your brain to see a market downturn not as a threat, but as the single greatest opportunity you'll have to build serious, long-term wealth. It takes guts, for sure. But it also takes preparation. You can't take advantage of a sale if you don't have any cash. And that brings us to the actionable part of the playbook. Section 5. How you can apply this principle today. You don't need billions of dollars to use this strategy. You just need to follow 3 simple rules. Rule 1. Build your crisis cash. The wealthy always have cash ready on the sidelines. They call it dry powder. This is money specifically set aside, waiting for an opportunity. You can't buy the dip if you're already fully invested or living paycheck to paycheck. Your first job is to consistently save a part of your income into a dedicated account. This is your opportunity fund. It's not your emergency fund. It's your "the world is on sale" fund. Rule 2. Know what you're buying. When the sale hits, Don't just buy stocks randomly because they've fallen. Have a watch list. For most people, the simplest and most effective strategy is to buy low-cost, broad market index funds, like one that tracks the S&P 500. This gives you a small piece of hundreds of the top companies. When the market dips, you're not trying to guess the one winner, you're buying the entire market at a discount. A strategy called dollar-cost averaging, where you invest a fixed amount of money at regular intervals, basically automates this process and takes the emotion out of it. Rule 3. Play the long game. This is not a get-rich-quick scheme. This is a proven path to building wealth over time. History is your best friend here. Every single stock market crash in US history has been followed by a recovery and a new all-time high. While big crashes like 2008 can take years to recover from, smaller corrections often bounce back in months. For instance, the sharp COVID-19 crash in 2020 recovered in just 141 days. The market's best days often happen right after the worst days, and if you miss them, you can seriously damage your long-term returns. The key is to buy quality during the panic and have the patience to hold on for years, not weeks. The playbook, when you boil it down, is surprisingly simple. It's not a secret, it's just hard to follow because it goes against every single one of our human instincts. It comes down to this. First, you have to shift your mindset. Crises are not threats, they are opportunities. Second, you have to prepare. Build up your cash reserves so that when the opportunity comes, you are ready to act. And third, you must execute. You have to find the courage to buy when everyone else is selling, and then have the patience to wait. Economic crises are inevitable. They are a feature, not a bug, of our economy. And in every single one, wealth doesn't just vanish, it gets transferred. It moves from the impatient to the patient, from the unprepared to the prepared. You know the playbook now. The only question is, the next time a crisis hits, which side of that transfer will you be on? If you're ready to build your own financial empire, make sure you watch the next video on my channel, Wealth Saga. And don't forget to like, subscribe, and share this with someone who needs to hear it.